All right, everyone. Thank you so much for joining us today. My name is Porfirio Coronado, and I'm here with Dallas Area Habitat for Humanity. And I am the Homeowner Services Assistant Manager. And today I have here with Ms. Rita Higgins, and also I believe Christian is on the line. And then we also have JJ that is working with our team as well. Today's topic is going to be about income tax and qualifying for a mortgage. So it's that time of the year, that we all are getting our last paycheck stub, or we already received our W-2 and we're ready to file those taxes, right? And a lot of times you can fall into some trouble with the IRS, depending on where you file, because they might not be doing your taxes to your benefit. They might say, like, I can get you a higher tax refund if we do this. So that's the purpose of today's class, is for us to talk more about taxes. So that's what we're going to speak to today. But thank you so much for joining us today. The webinar is recorded. So in the case that you find something that is that you find very informative and you would like to share with someone else, you could always direct them back to this webinar. It is being recorded. And then also we are on Facebook Live for the first time this year. We have not been able to get on Facebook in a while. So we are back into Facebook Live. So hello, everyone out there in Facebook that are joining us. Thank you so much for joining us as well. And feel free, throughout the presentation, if you have any questions, concerns, or do you want me to explain something more in depth, feel free to put it in the chat, send out a Q&A. We'll have a Q&A section at the end. And then that way I can assist you. Okay, I do come with a background in taxes. Before joining Dallas Area Habitat, I was working for another nonprofit preparing taxes. So we used to prepare taxes for low to moderate income families. So I do come with a background in taxes. I also majored in accounting with the specifics in taxation. So I bring this knowledge to you all. But again, if you want something to go more in depth, I will go more in depth. But today, the purpose of today is so that we can talk about taxes and qualifying for a mortgage. A lot of people don't realize how your taxes actually affect whenever you qualify for a mortgage. So without further ado, let me go ahead and share my screen, and we'll get started. And I'll turn on my camera because I will be looking at a different screen. Christian, will you please confirm that you're able to see my screen?
Yes, we can see it.
Thank you, Christian. All right, so income taxes and qualifying for a mortgage. Okay, so again, the purpose of this webinar is to discuss what every home buyer should know about your income taxes and how they can affect your ability to qualify for a mortgage and your purchase power. What do we mean about purchase power? The purchase power is like how much you can actually afford. Okay, like like how much can you afford based on your income? So you doing your taxes incorrectly can affect that. Okay. So the first thing that we're going to talk about is basic tax documents that you're going to be seeing. Okay. So for example, you have your tax return. Okay. So that's your actual 1040. Okay. So that's your form 1040 or 1040 AEZ. So in this form, this is what you what you would declare everything on. Okay. So that, such as your personal information, first name, last name, social security number, address, your filing status. Are you married? Are you single? Are you married, filing jointly? Are you married, filing separate? Are you single? And if you're single, are you single with dependents? Okay, which is head of household. So that's what you report on this tax return 1040. Okay, and then in here, every other form that you will be getting from your employers, your self-employment, all that goes into here. So this is basically the summary of your tax return. Okay, so then you also have a W-2. Okay, so your W-2, it's what you receive from your employer. If you are employed full-time or part-time by a company, you will be receiving a W-2. Okay, Now, in this W-2, it basically outlines what the total income that you have had throughout the year that you have been employed for that employer. Okay, so for example, if you work from January to December, then they're going to declare all that. But if you only work 2 months out of the year, they're going to declare that on your W-2. Okay, so if you have multiple jobs, for example, if you have a full-time job, but then you also have a part-time job, then you will be receiving multiple W-2s. Okay, so you take this W-2s to your tax preparer and file your tax return. So your W-2 will go into your 1040. Okay, how does a lender uses that W-2? So that lenders look at that W-2 and make sure that we are able to match those W-2s, whatever's reported on those W-2s, and match it to what you reported to the IRS on the tax return on the 1040. Okay. If there's any discrepancies, then we are going to, or the lender's going to say like, okay, so you are missing about $3,500. Where's that $3,500 that you're declaring on the IRS? And you know, a lot of times you might say, well, oh, that was another job that I had. So they're gonna say like, okay, we're gonna need that W-2. Okay, so that's what that is. Your W-4. Okay, so your W-4 is actually what your employer gives you for your withholdings. Okay, so your withholdings is actually what are you going to be declaring at the end of the year. Okay, so for example, you might say that to your employer that you are going to be declaring at the end of the year 2 dependents, right? Because it's you and another dependent that you have. So that's a total of 2. Then whenever you file that in your tax return, if you don't declare that, then chances are that they didn't take out enough taxes from your employer to cover that out. Okay, so what I'm trying to say with that is that the more dependents or withholdings you have, the less amount of taxes that you're going to be taking out each pay period, every time that you get paid. Okay, so which means that you will have a higher paycheck every pay period because they took out less taxes. And also at the end of the year, when you file your tax return, you're going to have a lower refund because they didn't withheld enough money. Okay, vice versa. If you declare that you have such a few amount of, or just like yourself, let's say for instance, you only declare that you're the only one that is going to file in your taxes, then at that time, they're going to take out a lot more taxes on each pay period, right? So which means that at the end of the year, you will probably receive a higher refund because most of your taxes already covered everything in there. Okay, so what I'm trying to say here is that you can't have both ways. Okay, you can't have a higher paycheck every pay period and also have a high tax refund. Okay, it's one or the other. Okay, you either get a higher paycheck every pay period or you get a higher refund because again, it goes based on that. Okay, now when you do your W-4 with your employers, you don't really have to file every dependent in there. Okay, for me, this is just a recommendation I usually give out. Okay, it's better for me for them to take out money and pay more taxes during every pay period than me paying more tax at the end of the year, because at least I know that they're going to cover it for like 26 pay periods in a year or 52 if you get paid every week. So my recommendation is that if you are married and you're going to be filing jointly with your spouse, you know, both of y'all go to your employer and change your W-4 to only like a single person. Okay, because that is going to take out more taxes. So which means that you're going to receive a lower paycheck stuff, but at least at the end of the year, you will not owe taxes and hopefully you will receive a higher refund. Okay, Now, you also have a 1099 miscellaneous. Okay, so the 1099 miscellaneous, it's basically for contract workers and miscellaneous work. Okay, and we're going to dive into it in later slides more on that. So I'll just leave it at that. 1099 miscellaneous. So it's like for self-employment, contract workers, or all of those. Okay. Now, you also might be getting a 1099K, which is a third-party network transaction. So a 1099K is for those people that work independently from the company that they work for, and they are getting either getting paid in cash or getting paid through a third party, such as like Zelle, Cash App, Venmo, any of those. Okay. Now the 1099K is very common if you are an Uber driver or Lyft driver. Okay, that's the type of form that you will be receiving. Okay, where they report like, okay, we collected this much money for this person, and this is how much they paid towards their fees with the ride sharing company, and this is how much they actually earn. Okay, so they will receive a 1099K. Okay, now form 1099G, that's for your government payments. Okay, your government payments are for unemployment. Okay, so if you receive unemployment anytime during the year that you're going to be filing, then you're going to receive this 1099. Okay, now unemployment is taxable income, which means that if they didn't withheld taxes from your unemployment, then chances are you're going to be paying taxes at the end of the year on that unemployment check. Okay, so anytime if for any reason you receive unemployment throughout the year, I suggest for you to go ahead and ask them to withhold the taxes. That way you don't have to pay them at the end of the year. Okay, to me, it's easier managing the taxes every pay period than having a lump sum of money at the end of the year when it's time to file. Okay, you will also have the common schedule, such as itemized. The schedule is called a Schedule A, which is itemized deductions. Okay, your itemized deductions is basically everything that all the expenses that you have. Okay, that are basically taxable. Okay, either you do the itemized, where you detailed every expenses, or you do the standard deduction. Okay, it is if your standard deduction is lower than your itemized, then the tax return will actually put it in there as like itemized. Okay, and it would ask you to list every expense. Now you also have schedules B's, which shows the interest and ordinary dividends. Okay, so if you receive interest or dividends from your bank, you will receive a form, and it will go on a Schedule B. Okay, and then you have a Schedule C. Okay, your Schedule C is your profit or loss from a business. Okay, this is where your 1099K and your 1099 miscellaneous goes into. So the 1099 miscellaneous, 1099K goes into the Schedule C, that then the Schedule C gets reported to your tax return, okay, to your 1040. And again, we'll go into detail. Okay, now this year, a lot of you all are going to be receiving the letter 6419. Okay, so this letter 6419 is for those individuals that received the advanced child tax credit. Okay, because you receive a portion of it, so that means that in the tax season you will receive the remaining of that child tax credit. Okay, so be on the lookout for that. All right, so how do I file? If you receive a W-2, then you will receive this by January 31st. Okay, detailing how much you earn throughout the year. Okay, again, if you have multiple jobs, you will get multiple W-2s. Okay, you report this to your tax return, to your 1040. Okay, now a big mistake that we see or that lenders see in qualifying people for a mortgage when they have a W-2 is that a lot of times the tax preparer writes off any expenses. So writing off expenses with a W-2, that reduces your income. Okay, so if it reduces your income, that means that you're able to afford less, right? So a lot of times, if you have a W-2 and you had expenses that your employer did not pay for, okay, I suggest for you to go ahead and take care of that with your employer, then actually reducing your income, because again, it's going to affect what you're able to afford. On the other hand, if you are self-employed, okay, then you will report this on your Form 1040 with your Schedule C, again, your profit and loss statement, and it's either going to be a profit, meaning that you actually made income on that business or side hustle, or is it a gain, or is it a loss, meaning that you were not profitable. And both of them have consequences to both. Okay, so we're going to go into, now we're going to talk more about, okay, so what if I'm self-employed? How does that affect me? So defining self-employment. So just because you don't own your business doesn't mean that you're not considered self-employed. Okay, about 30% of the workforce is considered self-employed according to the IRS. Okay, and this is probably higher now with COVID. Okay, because a lot of us are taking side hustles, like maybe driving for Uber or doing any other thing that we might be able to bring in cash. So if you receive income through any of the following ways, you may be considered self-employed. Okay, so for example, you have having a high side hustle. Maybe you participate in the gig economy. Working as a contractor or consultant. Okay, what's a contractor? Maybe you're a photographer, right? Maybe you're a consultant. Maybe you do something so well that someone else pays you to come teach it. Okay, or you actually do own a business, right? So then you are considered self-employed, right? So this is what defines self-employment. Okay. So what qualifies as a gig or side hustle? Independent contractors and consultants. Again, that might be, a photographer, videographer, editor, musical editor, anything that you consider contractor, that's considered a side hustle. Okay. Freelancer, photography, graphic design, etc. Okay. Also, if you have seasonal work, okay, or a temp job, driving for a ride share, such as Uber or Lyft. These are all ways that you will be considered like a side hustle or a second job to bring income to your household. Okay, delivering for Amazon, Instacart, DoorDash, all of those. Cosmetics, we see that a lot. If you're like a nail technician, hairstylist, or lash technician, all of that, it's considered a side hustle, or you're self-employed. Okay. So how does the loan affordability wealth self-employment? Okay, this is what we see a lot. Okay, so how long have you been doing this work? So lenders want to know, how long have you been doing this work, that if I was to lend you money, how could I trust that you're going to pay this back? Because you're going to be on a loan for at least 30 years. Okay, so lenders want to see that you at least have 2 years of generating income. Okay, and when they mean about 2 years, if they mean that you are at least profitable, meaning that in 2019 you earned $7,000, in 2020 hopefully you earn $10,000. In 2021, hopefully you earn $12,000 because your income should be increasing according to the IRS. Okay. So, and then also not just according to IRS, but according to your lender. Okay. And you want to show that your income is increasing because at least that shows that you are able to pay for that loan that you're trying to get to purchase a house or any loan that you're trying to get. Now, do you report the income on your taxes? Okay. So if you are self-employed, ask yourself, like, do I report this? And if so, do you declare income or a business loss? Okay. So again, it changes. Both of them have consequences, and some are more favorable than others. So calculate your annual income. Okay. So this is what they do. Lenders typically take the 2-year average of your taxable income. Okay, so that's your total income minus qualifiable adjustments. Okay, so if your total income, you said that you earned $40,000, but you had qualified adjustments of $30,000. So that only means that your income, your taxable income, is $10,000. And that's what the lender is going to see. They're not going to see the $40,000 that you had, because according to your taxes, you didn't actually have it because you wrote them off. This is called your adjusted gross income. That's what they're going to base it on. And the adjusted gross income is on your 1040 on the first page. So deductions and write-offs. Okay, so what do you need to know about it? So those who are self-employed often take advantage of legal deductions and write-offs allowed by the IRS. So what are legal taxable deductions? So according to the IRS, what is legal? It's anything that is ordinary and necessary for you to conduct your business or your side hustle. For example, if you're a Lyft driver, right? What is ordinary and necessary for you to conduct your business? You need a car, right? So in order for you to get the car, you need to pump gas. You need to put gas on that car. So that gas is ordinary and necessary to write it off, right? But just know, if you write it off, a lot of times it might not be profitable. So do you take that loss, or do you just declare your income without any expenses? And that's what we're going to discuss in a few slides. Just know that the deductions reduce the amount of income you're taxed on. Okay, and that's why a lot of people take those deductions. Okay, because they don't want to pay taxes on it, right? Again, you can't have both ways. Either you pay taxes on it, or reduce your income, but you won't qualify for a loan, or you run the risk not to qualify for a loan. So think about, what's more advantageous for me right now to do. However, the amount of income taxes on your adjusted gross income is shown as on your 1040. Is what lenders analyze when considering your loan approval. Okay, the lenders do not include or do not look at what you actually made before those deductions. Okay, they declare what you made after those deductions, because remember, that's what you're telling them. That's where you're saying, like, okay, I had $40,000, but out of those $40,000, I spent $30,000 in expenses, ordinary and necessary expenses. So I'd only made $10,000. So lenders are going to qualify you based on that adjusted gross income of $10,000, right? So be careful with that. This holds true even if you have a primary employment, okay, and you deduct your taxes, or you reduce your income to pay less taxes. Okay, there's no way that anyone can give you extra money whenever you file taxes. I know that a lot of times people, and when I say people, I mean about tax preparers, they say like, I can give you more tax, more money, more refund money than that other person across the street. Okay, there's no way. Okay, the only way that they could do that is if they reduce your household income, meaning that they're going to take out deductions and your taxable income is going to be less. How do they do that? They add stuff that they shouldn't be adding, like maybe like expenses that you don't even have. So yes. So let's look at the 1040. Okay. And I love talking about taxes, y'all. So 1040. So in here, again, it talks about, it has everything in there, such as your first name, last name, your social security number, your address, and your dependents, if you're gonna have dependents, okay? Now, what I really want you to pay attention to here is your other income, okay? Your other income, it's like your self-employment or your side hustle, you know, anything that you declare on that, or that you declare on that Schedule C, that will go into this other income, okay? If you receive like a W-2 and all that, that will be your first, that will be the first number that you see, line 1. It's always going to be there. Okay, so your W-2s are going to be on line 1. Your other income, it's going to be on line 8. Okay, and then after that, then they have the total income. Okay, so which basically what it is, it adds line 1 through 8, or, you know, your income plus other income, basically. From there, if you took any deductions, then you're going to have a GI, which is line 11. Okay, in line 11, your adjusted gross income is what the lender is going to see or use to qualify you for a mortgage. Okay, so I have an example for you, and follow me through this. I wish I could talk to me, but it's okay. I will read it. It says, John's story. John works as a full-time medical assistant. Okay, he is paid hourly by his employer and receives a W-2 each year. Additionally, John began driving for Uber Eats in his free time to generate extra income. He filed his income he filed the income to make from the job and his taxes as well. In 2021, John earned $50,000 from his primary job, which his primary job is medical assistant. So he earned $50,000 in there. He also reported $10,000 in income from his side hustle. So from him driving Uber, he reported $10,000. Okay. When filing his taxes, John and his tax professional decided to declare the $10,000 income without taking any deductions, meaning that he did not take any ordinary and necessary deductions. Even if he did have any, he didn't take out. He didn't take any deductions. Okay, so let's look at a few of John Key income information. In this case, we have John, right? He says that he is earning $10,000, right? And as you see in here, you have the $10,000 here as well, because again, he didn't take out any expenses. So his $10,000 is reported in his profit and loss statement. Okay, and then this is reported over to the 1040. Okay, so I want you to look at the $10,000 that he earned, and then also that, of course, he didn't have no expenses, so he still has $10,000 that he's reporting to the IRS. Okay. So in here, you see that that John, his $50,000 is in there. Where does that $50,000 come from? Anyone on the chat? Where does the $15,000 come from? Sharif, yes, from the W-2 is his primary job. Yes, Alfredo, yeah. So $50,000 is from his primary job, right? You see in there, you also have line 8, you have the $10,000. So that's what he reported on his profit and loss schedule. So which means that he has $60,000, okay? So my question to you all is, what income would a lender use to calculate John's affordability? What do you think? Tarif, $60,000. Does everyone agree with the Tarif? Makita says 47,450. Odette says line 11, which is $60,000. Sarah says 50. Okay, so remember, they're going to go based on the adjusted gross income, which is in his adjusted gross income is $60,000. Okay. So your lenders are going to go based on your adjusted gross income. In this case, it's $60,000. All right, so I have a question for y'all. So if John earns $60,000 according to his tax return, he can afford about 3 times his annual income. Approximately, what is his buying power? I feel like I'm doing like a math class now. Marquita says $180,000, Sarah $180,000. That is correct. Yes. So if John earns $60,000 and he could afford approximately about 3 times his annual income, then yes, he could afford a $180,000 loan. Okay. And that's how basically lenders do it. Okay. Aside from other things, they look at credit, income, and everything. But, you know, like simple stuff, they do this. Okay. Like, okay, you earn this much, you know, you can afford this much. So yes, so that's what they do. So what if John's story was different, right? So we have John. Again, John is a full-time medical assistant. He's paid hourly by his employer and receives a W-2 each year. Additionally, John began driving for Uber Eats and in his free time to generate extra income. He filed the income he makes from his job on his tax return as well. Okay. In 2021, John earned the $50,000 from his primary job. He also reported $10,000 income from his side hustle. When filing his taxes, John and his tax professional decided to deduct qualifying expenses related to his side hustle, i.e. Vehicle depreciation. After filing expenses, John has a business loss totaling $15,000. Okay, let's look at how the business loss affects John's by reviewing his income tax documents. So again, we have John, which is earning $10,000, right? From his, that's what he got paid. He made $10,000. However, John said that he had $25,000 on vehicle depreciation. Okay. So the difference between 25,000 and 10,000, that's 15,000. Okay. And that is the loss. So what does that mean? It means that John was basically conducting this business without being profitable, meaning without making any money. It could be that, yes, he was conducting, he was not making any money, right? Or it could be that he just did that, or his tax preparer just did that so that he doesn't have to pay taxes on $10,000 or taxes on the difference between his income and his expenses. Okay, because let's be honest, the more income, and especially income that comes from this form on the profit and loss statement, you're going to pay taxes on it. Okay, and a lot of people don't want to do that. But keep in mind, you're not paying taxes whenever you're getting paid every time you get paid on that business or side hustle, right? So you reporting to the IRS is the only time that they can collect taxes on it. Okay, so in this situation, John's side hustle was not profitable. So let's look at the tax return again. Again, we have the $50,000 that comes from his primary job, right? From being a medical assistant, okay? And then in here, you see the $15,000 loss. That reduces to $15,000, and his adjusted gross income is now $35,000, okay? So what income would a lender use to calculate John's affordability? Tarif is on it, 35K. That is correct, 35K. So because again, lenders use the adjusted gross income, okay, of $35,000. Okay, so my same question to you all. If John earns $35,000 according to his IRS tax return, he could afford 3 times his annual income. Approximately, what is his buying power? Sarah said 105. That is correct. Okay, so now you see how you taking a loss on a business, right? Your buying power from 180 to 105. It's a big difference, as Aretha said in there, you know. So that's how your self-employment can affect it if you don't file it right. It's always, yes, it's almost double the amount. Yeah. So again, we as counselors always try to tell clients, like, whenever you try to purchase a house, you want to show as much income as possible you have, because again, you are going to want to borrow this money, right? And you want to purchase a house or you get this loan. So it's better to show the more income you have to qualify for that loan, right? I know that a lot of times it might be that you don't want to pay taxes on $10,000, right? Because $10,000, it's about $1,200 in taxes that you will pay. And if you're receiving a refund, they're going to take it out of there, right? But what's more important to you? Not pay taxes 1 year. Not pay taxes 1 year, or afford a house, or not afford a house, right? So keep that in mind whenever you file your taxes. So be mindful, the IRS have made some changes, okay? I know you probably heard that Zelle, Cash App, Venmo, they're now going to start issuing 1099-Ks for those individuals that occur more than $600 of annual income in transactions, okay? That is true, but it's only for commercial, okay? So Zelle, Venmo, and Cash App, they will now have designation to where you can actually say, like, okay, this is a friend and family. Okay, this is not a business transaction that I'm making, right? And whenever you designate as a friends and family, you will not get a 1099-K. Okay, it's only for those individuals that take Venmo, Cash App, you know, and report it later on. Okay, so a lot of times it's for like food trucks. You know, if you run a food truck and you use Venmo, Cash App, and all that, then again, if it's over $600, it is a business that you're conducting, so you will get a 1099-K. But if you're just getting $50 from your sister, $50 from your brother for your birthday or anything, you know, reimbursement of anything, as long as they're designated as a family, friends and family, you will not get the 1099-K that they're referring to. Okay. If you received the advanced child tax credit in 2021, last year, seems like it was so long ago, but it was just a few months ago, you will receive the letter 6419 to claim the remainings of your child tax credit. What that means is that the remaining, meaning that you've already got part of it. So don't be alarmed if you don't get the same tax refund that you've been accustomed to receiving, right? Because you've already received part of it during last year, during the advanced tax credit. So if you have not received your 6419, wait for it before you file it. If you have not received it and you received those payments last year, okay, from the IRS, because it's going to hold up your refund. As always, let's make a plan. Okay, you're receiving a tax refund, right? If you are receiving a tax refund, a lot of you all are probably want to like, okay, what do I do with that tax refund? Well, I'm glad you asked, because we are saying, maybe create a cash flow budget, right? Maybe like where you tracking the timing of your income and expenses to make sure that you have enough week to week, okay? Or, use that part of that income or that tax refund to pay for debt, okay? You can use your snowball method. You can use your the avalanche method, okay? But that's another way that you can take that tax refund and help you out in this home buying journey. Maybe make a plan to save. If you've already paid off your debt, you're good with your budget on the monthly basis, weekly basis, whatever that might be, save that tax refund. Okay, save. Okay, and if you don't save it all, you might want to do something to yourself, right? You've worked so hard for this for that year. It's okay to treat yourself sometimes, and maybe like going to like the Bad Bunny concert or getting your nails, but whatever the case might be, do something for yourself. But I would highly encourage to save it instead. Okay, so that's just a few things that to make a plan on. That's right. How about a down payment on a home? Okay, save it for the down payment on a house too. All right, so key takeaways. So most people are considered self-employed by the IRS, then more people are considered by the IRS self-employed than who self-identified. For example, you might drive an Uber or Lyft and you don't think you're self-employed, but it's still considered self-employment according to the IRS, okay? Always review your taxes before signing, okay? That is very important, okay? Because the IRS will never go back to the tax preparer, okay? No matter what the tax preparer tells you, like they will be there for you in the case that you get audited. Yeah, they probably will be there because you're gonna go and knock on the door and and go up to them. But the person that is signing that document is you, meaning that you are declaring that what you are putting on that tax return is actual factual information. Okay, so review it before you sign it. So if you see something sketchy on it, more than likely it will probably be sketchy. Okay, if you see like, hey, how do I go from like $50,000 in my W-2 job or like my primary job, but my adjusted gross income was 35,000. Where's this $15,000 coming from? Right? Ask questions. Right? You pay them for a service. Okay? If you pay. Be aware of unlawful taxes used by tax preparers to reduce your tax liability. Okay, again, like claiming like a business loss if you don't own a business. Again, that is probably that is probably the only way that you can get more money is by claiming a business loss, even if you don't have it. Because again, the IRS doesn't know if you do or you don't have a business. Okay, so they're only going based on what you report them. Or overstating to write off deductions. Okay, so for example, maybe John Doe on his employer, where he earned $10,000 for self-employment, maybe he didn't have the 25,000 car expenses. Maybe it was only $5,000 that he had in car expenses. But his tax preparer probably told him, like, well, you can reduce more, and that way you don't pay taxes on the remaining. Again, that reduces your tax liability, which reduces your income. If you catch inaccurate information after filing, you can amend if needed. Okay. Note, amending requires that you pay taxes owed that were not paid at the time of filing. Okay, so let's say, for instance, that you did your taxes in 2020 and you're now going back to it. And it's like, oh, I forgot. I mean, I claim a loss when I really didn't have a loss on my income. Then because you could amend it to remove that loss, but now you're gonna have to return some of that tax refund or pay taxes on it. Again, income is not everything that a lender qualifies or looks at when qualifying for a mortgage. They take in consideration your credit score, your credit score, credit history, savings are factored in it as well. Okay, but income is a big chunk of it. Resource. If you are in doubt on what you should claim, not you should claim, but or like your self-employment, how you should file it, consult with your homeownership counselor. Myself, Christian, Aretha, we're always there if you're in a counseling program to guide you through that and see what's the best option for you. Okay. Because again, we don't want you to be at the end hour and you don't afford a mortgage. Okay. Also, there is a VITA income tax program. Okay, if you earn less than $57,000 a year, you are able to get your taxes done for free at a VITA site. So it's called a Volunteer Income Tax Assistance Program. Okay, typically they are in the public libraries. We have partnered with one a couple of times. It's called Dallas Community Tax Centers. I'm going to post their website on the chat because again, use them. They're free. They don't charge anything. Like they could not even take any tips, nor whatever, like any source of tips. So use them. They're there to assist you for free. Okay, and that is the website. It's Dallas Tax Centers. And again, they do it virtually. They also have in-person offices where you can go get them done in there. And they do electronically filing for free. A lot of places they charge to file your taxes electronically when this resource is there for you to file for free. And then we also have PocketWise. If you are more interested in seeing what else, how does your income affect your mortgage, then look at the mortgage calculators in there. It tells you a lot. Any questions? I feel like I talked a lot, and I don't know if you have any questions. Feel free to put them in the chat or send me the Q&A. I will look at them now. No questions? Wait, what? Thank you, Alfredo and Shara. No questions. Wow. Okay. So you are ready to file your taxes. Actually, yesterday was the first day to file your taxes. So you are now able to electronically file your taxes as of yesterday. You have until April 15th to file this year. Again, the longer you wait, especially if you are going to be paying money back to the IRS, then do it as soon as possible. Okay. So who is going to get a tax refund and is going to use it towards a down payment or to save it? I better see everyone in there. Oh, I say I. Okay, I see people raising their hand. Bernice, hey, okay. I'm gonna take you up on that, Miss Bernice. Victoria, Melissa Elridge, okay. Tamika, they're using their IRS, their tax refund to pay for tax. I'm sorry, to down payment on their house, which is probably the best way. Joking aside, I talked about the concert, but I mean, is it really worth it one night at a concert when I can save it more towards something that I can have long term? Yes, Ms. Janet Campos. Odette has a question. Will lenders use tax refund AGI? If you are self-employed, lenders would take the average, okay? That's the only time that they would take an average, okay? Now, if you are just salary income, like meaning that you only have a W-2, then they would only go based on your income that you've earning throughout the year. So in that case, your salary increased, then they would go based on that. They would not do the average. We do have a next webinar coming up this month. So, stay tuned for us. We try to host about 2 webinars per month. And they are listed in our webinar calendar. And again, this webinar is recorded. In the case that you found the information helpful and you want to share with friends and family, direct them to our website and it's there on demand. Okay. Eric is asking, should we wait until we file this tax year before proceeding? It all depends. Legally, the lenders should not request or require your this year's tax return or your filing your previous year tax returns, because it's still not the end of the tax period. After April 15, then yes, they could require for you to submit those before you proceeding. But right now, it all depends if you're going to be, if you have a self-employment income in there and you're going to show that you have higher income than what you did in previous years, then yes, it will probably benefit you to wait until you file. But yeah. Yes, we have our class on property taxes and exemptions, the February the 8th, okay? That class is very informative. If you found this class informative, that other class is way more informative because we bring a partner, Miss, forget her name, but it's from the Dallas Central Appraisal District. And they will be talking about homestead exemptions. How does that affect, your taxes once you're already living in the house, okay? I know that you're not there yet as far as like living in the house, but it might be this year. And I hope it is, okay? So, it's very good for you to be informed already on homestead exemptions, because you could always pass that knowledge to someone else. Someone that is going through already bought a house and says like, oh, my taxes increased. I don't know why. You say like, you know what? I took this class with Dallas Area Habitat. This is why your taxes increased. That's because you don't have a homestead exemption. This is how you file it. I'll show you. So join us on February the 8th for that class. Okay. Any other questions? Ashar is what's qualifying annual So what is the qualifying annual amount of income for Dallas Habitat? Yes, for Dallas Habitat, there's really no qualifiable income. You have to be able to afford a mortgage, okay? And what do we say about a mortgage? So we looked at John Doe's scenario, right? Do you think that John Doe could afford a mortgage on his adjusted gross income of $35,000, or does he have a better chance on the $60,000, right? So it all depends on that. You know, when do you have a better chance on affording an actual mortgage? It's not so much as like what's the income that you have to qualify. It's like, could you afford a mortgage based on your income? Okay. The class that we're going to have next month on February the 8th, it is going to be from 6 to 7 as well. Okay. Eric. Yeah, Mr. Eric, I did receive your email. I will get back to you tomorrow. But yes, anytime that you have any questions, bro, if you're not directly in contact with a counselor, reach out to our homeowner support at DallasAreaHabitat.org, and they will be able to guide you to the right question or the right person. Okay. Any other questions, concerns? All right, everyone. Well, thank you so much for joining us today. And hopefully you found this informative. If you still have questions and you want something for me to explain to you better, feel free to reach out. I am always an email away. It might take me a while to get back to you, but I will get back to you. Okay. So just send us an email, call us, or whatever you want to do. And I hope to see you next time on February the 8th for our next class. Oh, yes. Go ahead and ask me the question. Oh, okay. I did not see it. Give me 1 second. Oh, yes. So regarding where does Habitat build? So Dallas Area Habitat builds in various neighborhoods. Typically, Dallas Area Habitat builds in Dallas County, which Mesquite and Balch Springs, it is in Dallas County, but it is not a priority neighborhood. However, we do have a sister organization that builds more like more in those areas. So if we're not able to assist you in our program, then you can go through our homeownership counseling, and we could refer you over to that person or to that department.